Everyone follows a plan, one written by others. But you are here to follow your own. Welcome to your Plan B. Most people work for money. But the wealthy, they make money work for them. The secret lies in one word: assets. In today's video, we'll break down what assets really are, why they matter, and how you can start acquiring them, no matter your income level. What are assets? Let's start with a simple but powerful question. What exactly is an asset? In the world of personal finance, an asset is anything that puts money into your pocket, either now or in the future. It's something that works for you, even when you're not working. Think about it this way. If you own a house and rent it out, the rent you receive is income. That house is an asset. If you own shares in a company and receive dividends, those shares are assets. If you write an ebook and it keeps selling online, that's a digital asset. But here's where many people get confused. They think that anything expensive is an asset. A new car? A luxury watch? A big house you live in? Not necessarily. Let's break it down with a simple rule from Robert Kiyosaki, author of Rich Dad Poor Dad. An asset puts money in your pocket. A liability takes money out. So, if your car costs you fuel, insurance, and maintenance, but doesn't earn you anything, it's a liability, not an asset. Even your personal home, unless it generates income, is not a true asset in financial terms. Now, why are assets so important? Because they are the foundation of wealth. When you have assets, you're not just trading time for money. You're building systems that generate income passively. This is how people escape the paycheck-to-paycheck cycle. Let's look at a few examples. A rental property earns you rent every month. A stock portfolio grows in value and pays dividends. A YouTube channel with monetized videos earns ad revenue. A mobile app you've developed can bring in sales 24/7. These are all assets. And the best part? Once you own them, they can keep generating income with little to no extra effort. But not all assets are created equal. Some require more time, knowledge, or capital to acquire. Some are riskier than others. And some grow faster, while others are more stable. The key is to understand what qualifies as an asset in your life, and to start building your own portfolio, one step at a time. So next time you think about buying something, ask yourself, will this put money in my pocket, or take it out? That one question can change the way you see money forever. Types of assets. Now that we understand what an asset is, let's explore the different types of assets you can own. Not all assets are created equal. Some are physical, others are digital. Some require a lot of money to start, while others need only time and creativity. Let's break them down into 6 main categories. 1. Real estate assets. These are properties that generate income or appreciate in value. Think rental apartments, commercial buildings, or even land. When you rent out a property, the rent becomes passive income. And over time, the property itself may increase in value. Real estate is often seen as a stable, long-term investment. 2. Paper assets. These are the most common and accessible assets. They include stocks, bonds, mutual funds, and ETFs. When you buy a stock, you own a piece of a company. If the company grows, your investment grows. Some stocks also pay dividends, regular payments to shareholders. Paper assets are easy to buy and sell, and they're a great way to start investing with small amounts. 3. Business assets. If you own a business, or part of one, you own a powerful asset. A business can generate income, grow in value, and even run without your daily involvement. This includes physical businesses like a coffee shop, or online businesses like an e-commerce store. You can also invest in other people's businesses through private equity or crowdfunding platforms. 4. Digital assets. In today's world, digital assets are booming. These include e-books, online courses, YouTube channels, blogs, and even NFTs. Once created, they can generate income repeatedly with little extra effort. For example, a course you record once can be sold thousands of times. Digital assets are scalable and often have low startup costs. 5. Commodities. These are physical goods like gold, silver, oil, or agricultural products. They're often used as a hedge against inflation or economic uncertainty. While they don't generate income directly, their value can increase over time. Gold, for example, has been a store of value for centuries. 6. Intellectual property. This includes patents, trademarks, copyrights, and royalties. If you invent something, write a song, or create a brand, you can earn money every time someone uses it. It's a powerful way to earn passive income from your creativity and innovation. Each of these asset types has its own risks, rewards, and requirements. Some are better for beginners, others for experienced investors. The key is to choose what fits your goals, your skills, and your resources. So, you understand what assets are, and you know the different types. But the big question is, how do you actually start acquiring them? The good news? You don't need to be rich. You just need a plan, discipline, and a long-term mindset. Let's walk through 5 practical steps to help you begin building your asset base, starting today. Step 1. Educate yourself. Before you invest a single euro, invest in your knowledge. Read books, watch videos, take online courses about personal finance, investing, and asset management. The more you understand how money works, the better decisions you'll make. Knowledge is your first and most powerful asset. Step 2. Save strategically. You can't invest if you don't have capital. Start by tracking your income and expenses. Cut unnecessary spending and redirect that money into a savings or investment account. Even saving 50 euros or 100 euros a month can make a difference over time. The goal is to build a habit of saving with purpose. Step 3. Start small. You don't need thousands to begin. Buy your first stock using a commission-free investing app. Invest in a REIT to get exposure to real estate. Create a simple digital product like an e-book or a printable. The key is to take action, even if it's small. Momentum builds confidence. Step 4. Reinvest your profits. Once your assets start generating income, don't spend it, reinvest it. Use dividends, rental income, or digital sales to buy more assets. This is how you build compound growth, where your money starts making more money. It's the secret behind long-term wealth. Step 5. Diversify. Don't rely on just one type of asset. Spread your investments across different categories: stocks, real estate, digital products, maybe even a small business. Diversification reduces risk and increases your chances of long-term success. If one asset underperforms, others can balance it out. Remember, acquiring assets isn't about getting rich overnight. It's about building a strong financial foundation that supports you for life. Start where you are, use what you have, and grow step by step. Your future self will thank you. Acquiring assets is a powerful way to build wealth, but only if you avoid the common traps that can slow you down or even set you back. Let's go through the most frequent mistakes people make when trying to build their asset portfolio, and how you can avoid them. First mistake: Confusing liabilities with assets. Many people buy things they think are assets, but they're actually liabilities. A new car, a big house, or expensive gadgets might look impressive, but if they don't generate income or grow in value, they're not assets. Ask yourself, does this put money in my pocket, or take it out? Second mistake, chasing quick profits. Trying to get rich fast is one of the fastest ways to lose money. High-risk investments, meme stocks, or crypto hype can be tempting, but without proper research, they're dangerous. Wealth is built over time, not overnight. Focus on long-term value, not short-term excitement. Third mistake, not doing your own research. Relying on tips from friends, influencers, or social media without understanding the investment is risky. Before you buy any asset, learn how it works, what the risks are, and how it fits into your financial goals. If you don't understand it, don't invest in it. Fourth mistake, ignoring inflation and taxes. Even if your asset grows in value, inflation can eat away at your real returns. And taxes can reduce your profits if you're not prepared. Make sure you understand how your investments are taxed and how to protect your purchasing power over time. Fifth mistake, lack of diversification. Putting all your money into one asset, like just stocks or just real estate, is risky. If that asset drops in value, your entire portfolio suffers. Diversify across different asset types to reduce risk and increase stability. Sixth mistake, emotional decision-making. Fear and greed are terrible financial advisors. Don't panic when markets drop, and don't get greedy when they rise. Stick to your strategy, stay informed, and make decisions based on logic, not emotion. Building wealth through assets is a journey. Avoiding these common mistakes will help you stay on track, protect your investments, and grow your financial future with confidence. Learn, plan, and stay disciplined, and your assets will work for you, not against you. Assets are the foundation of financial freedom. Start small, stay consistent, and let time do the heavy lifting. What asset are you planning to acquire first? Let us know in the comments. Thank you for watching. If you enjoyed it, don't forget to like and subscribe.